So good morning, everyone, and welcome to our coffee chat on digital assets. My name is Katya. I'm an independent director and ILA board member, and I'll be your moderator for today's session. And I'm here with our digital assets expert, Veronica and Zhao, and I will let them introduce themselves in just a moment. And before we begin, just a couple of quick housekeeping points. So first of all, please keep your microphone muted throughout the session. And secondly, feel free to drop your question in the chat at any time, and we'll pick them up as we go. So after the introduction, we will start straight away with a short warm-up quiz to get a sense of your current level of knowledge and your expectations for today. And this will help us to tailor the discussion and ensure it's relevant and practical as possible. So over to you, Veronica and Zhao. Please tell us a little bit about it.
Thank you, Katya. So I'm Veronica Martinez. I'm an independent director and independent advisor. Currently, I also have a role in Switzerland where I'm partner at the Insurance Academy. My experience is mostly on the high net worth individuals and investment family offices side. I've spent the last 8 years working with life insurance companies and private bank on enhancement of their services and solutions. And my passion is really bridging the gap between financial, traditional finance and new technology. So that's one of the reasons why I'm here today.
Perfect. Zhao?
Okay, thank you. Good morning, everyone. Happy to be here to talk to you today. My name is João Amaral, and I'm currently responsible for the regulatory effort of Montes Digital SA here in Luxembourg. We are an applicant CSD, which means that we are applying to a CSSF license to operate a CSD and security settlement system here in Luxembourg. Montes will be based on blockchain technology, and this I'm bringing 18 years of experience at Clearstream Banking to the table, and it has been a fantastic journey so far. I've been with the company for just over 5 months, and part of my job is to create, once we get the license, the second line of defense of Montes, which delves into all the governance and risk considerations. So I'm going to share a little bit of my experience in this area, in particular from a non-executive director point of view, which I think is of most of your interest. So looking forward to the discussion.
Oh, sure. So, okay, so as I mentioned in the beginning, we have a short quiz for you. We have only 3 questions, so your participation would be much appreciated. I think we have almost full house here, so let's start with question number 1, please. So, how familiar are you with digital assets and or blockchain? Okay, so far I see we have only 2 experts here, Veronica and Zhao. The majority has basic notions. So the majority are beginners, no experts here. Okay, some people with some notions. Okay, it's very helpful. So the majority, almost 60%, has some notions. Okay, I think everyone has voted so far. No, 82% participated, which is already good. It will allow us to tailor the session. Okay, shall we jump to the second question, please? Okay. So, what is your current level of involvement with blockchain and digital assets? Single choice question, please. Okay, so this is what I thought. We're in a wait and see mode. Majority, I don't know. It hasn't been discussed. 31%. Okay, only 8%. I have implemented blockchain solutions at my organization. Okay, also very helpful. People are still voting, so let's wait a little bit. Okay, all right. And the last question, please. So, what aspects of digital asset presents the greatest opportunity for your organization? Okay, so it seems that majority has opted for operational efficiency and cost reduction. And secondly, we have new product offering and client solution. Okay, that's interesting. And we're almost done. Okay, perfect. I suggest to end. And yeah, and it's over to Veronica to explain you some fundamentals behind digital assets. Please, Veronica.
Thank you, Katia. If we could move to the second slide, that would be nice. So, well, in this session, we're gonna do our best to cover as much as we can, but as you know, we have limited time, and blockchain and digital assets is a wide topic. We see that the majority of you already have some notions, so we will do our best to see if we can expand a little bit those notions and refresh, you know, the latest trends. And we are going to cover as well the status of the market, regulatory landscape, and the risk and governance aspects of blockchain and digital assets. So moving to the next slide. Following one, yes, because this was already reminded by Katia. So just to establish some foundations, especially for the ones who might be a little bit green on the topic. When we talk about blockchain, just to put it in simple terms, we are talking about a shared ledger. And the way a shared ledger works could be similar to, imagine like a shared Google Doc, right? Or a shared Word doc, where everyone can access and write something and add something to the document, right? But the key difference is that whatever is written, whatever is changed in the document is immutable. It cannot be changed. It's going to be recorded forever. And each of those records, in order to happen, needs a consensus mechanism. And that consensus mechanism usually is a mathematical consensus mechanism. So when we talk about blockchain and we talk about distributed ledger, it means that that ledger is distributed across different nodes. Nodes can be computers, mobile phones. So that's what usually makes the centralized systems more robust, because they are spread across different devices, rather than a centralized ledger where only one single authority has the power to write something in that document, to write something in that ledger. So that's what makes blockchain quite special, and what allows blockchain to deliver that level of trust. Then obviously we have different types of tokens that are the representation of assets or rights in the blockchain. We have security tokens that are similar to financial securities, as you can imagine. So it's a blockchain representation of, for example, a bond or a stock or a share of a fund. We also have utility tokens. Utility tokens are tokens that allow you to access a specific service within the blockchain. So think about the blockchain as a little bit like the internet. So if you want to have access to a specific service within the blockchain, to a specific platform, you might need to have utility tokens. So for instance, when you go to a casino and you eat in the casino, you don't play with cash, you play with the tokens, with the chips that they give to you. So for some platforms to run, to make that platform, work for you, you will need some sort of utility tokens to be able to access the platform and run the service of that specific platform. And finally, obviously, we have payment tokens that represent, value transfer. So here we can talk about, for instance, the digital euro, stable coins. So usually they have a value that is pegged to a fiat currency, and they are used as a means of payment. Those are the three types of tokens. High level, obviously, we are not going to focus in all of them in this discussion. Then something also very important that we want to highlight is the concept of digital wallets. So digital wallets, contrary to what people usually think about, is a wallet that stores the private key. It's not a wallet that stores the tokens or the crypto. It's a wallet that stores the private key. And the private key, you can look at it in a way like when you are a participant in the blockchain, you have a public key. So public key could be similar to your email address or your IBAN, the IBAN of your account. That would be your public key. So people can use it to transact with you and to interact with you in the blockchain, to send you payments, for example. And then you have your private key that will be the equivalent to your password, could be the equivalent of your password that you have to access your banking application in order to make transactions within your bank account. There are different types of digital wallets. There are what we call cold and hot wallets. The cold wallets are the ones that are not connected to the internet. So a cold wallet can be a piece of paper where you wrote your private key, as simple as that. Could be a USB stick. Could be, there are many different types of cold wallet options. And those are the ones that are not connected to the internet. And there are hot wallets. There are different types, and there are wallets that are connected to the internet. So depending on the needs, there are different choices. And same as with a bank account, if a financial institution wishes to use a blockchain, they will have to decide how they want to do it. What will be their custody model? They are going to have an omnibus wallet structure. They are going to use a third-party provider like Fireblocks or Copper, how they want to set it up. And finally, some interesting concepts as well. Smart contracts. So some blockchain allow the possibility to write code on top of a blockchain. So for example, Ethereum blockchain allows for smart contracts to be written on top of that structure. And those smart contracts are basically self-executing code for agreements. So we, for example, can agree that if, imagine you are a farmer, and if there is, I am an insurance company, so if there is a meteorological catastrophic event, and that smart contract has been coded that when he receives the weather information, he will receive the alert, the catastrophic event that has actually happened, will receive satellite images, for example, that catastrophic event has actually happened and has impacted your farm. This smart contract could release already a compensation for you to handle the repair and try to control the situation. You can benefit from that auto-executable smart contract without having to imagine, having all this claim documentation. So it can be auto-executed directly, so which gives high level of automation and efficiency to this type of operations. And just to finalize, two concepts that are also quite interesting: the concept of decentralized autonomous organizations. So those are organizations that actually don't need us. They don't need independent directors. They don't need a board, because they are completely decentralized by the participants of that specific organization. How they do that? They do that via smart contracts, via a system of incentives with tokens and voting rights. So whatever is voted is usually auto-executed via smart contract. And that allows this type of organizations, decentralized organizations, to survive in this blockchain environment. And then just last but not least, applications. So because it's possible to code on top of these blockchains, on these blockchain networks, there is a possibility as well to create what we call decentralized applications. So same way that you have an application on your phone, you can, for instance, join a decentralized application that is coded and is active within a blockchain network.
Perfect. That's very interesting, Veronica. It gives us the good base for the session today. So I suggest to move to the next slide, please. And here, one question for you, Veronica. So we'll see major institutions such as Franklin Templeton, BlackRock, or JP Morgan investing heavily in blockchain infrastructure. So could you please tell us a little bit, how are these early movers gaining a competitive advantage in what does this mean for the rest of the financial industry?
Thank you, Katia. So currently we are seeing a lot of news about the financial industry, institutions entering into the digital assets and the blockchain world. We are seeing different trends. So some of them, they are really focusing on gaining advantage by creating this kind of infrastructure, this kind of pipeline that later on could be used by other market participants. So that's the example, for instance, of the Onyx platform of JP Morgan. So they have built this amazing, huge platform where the last year they managed to record more than 30 trillions of transactions. So it's quite huge. And they are really building these pipelines because the financial sector somehow remains really fragmented. There are a lot of institutions working in isolation with their centralized ledgers, and managing to really create a higher level of automation that benefits the entire market and elevates the capital markets. It's going to be key in the upcoming years. So the quick players that manage to build that pipeline, that framework, that then other players in the future might be on board with, will definitely have a big competitive advantage. Then, of course, we also have other strategic implications. So, for example, the new generation of clients. We could see that around 70% of high net worth individuals, they hold some sort of crypto. Sorry, high net worth individuals below 40, they hold some sort of crypto. We see that there is going to be a big wealth transfer happening in the next years, where they calculate that about 84 trillions are going to change hands from the older generations to the new generations. And these new generations, if they are not going to be satisfied with the way traditional finance work, they are really going to look for digital native solutions. So there is a high chance that they will demand 24/7 access, 24/7 transactions, immediate settlements, etc. And those kind of demands will be mostly be fulfilled by having some sort of blockchain technology back in the map. So those are kind of the two main strategic implications at this stage on the client side, and also on the infrastructure and leadership angle.
Understood. And listen, based on your experience working with different financial institutions, what do you see as the most compelling blockchain use cases the board should be looking at today?
Good question. So one of the most compelling use cases that honestly I think should be presented in any board meeting when blockchain is going to be discussed is the Spunta project. The Spunta project is a project that started more than 5 years ago in Italy. It was done by an association or consortium similar to what we have here in Luxembourg that is called the ABBL. So it's the banking association. So this project was started by them to optimize the interbanking reconciliation. So they started their own blockchain network, because the same way that blockchains can be public or private. So they started their own like kind of private network where the nodes are banks, are owned by the banks. These computers are owned by the banks. They started this network and they deploy smart contracts to try to reduce the cost and the time as well that they were using for interbanking reconciliation. So they move from 30-50 days to trying to solve, those cases where the reconciliation was not matching, which is usually a manual process. So 30-50 days is a long time, to 1 day. So in the past, they used to have like 10% of errors. So 10% of, cases where the interbanking reconciliations were not really matching. And that 10% usually was taking 30-50 days, and then they moved to 1 day. So right now, around 99% of the banks in Italy are using this system, are using Spunta for the interbanking reconciliation. And now they decided to open it to international banks. And there are some French banks and some German banks that are also starting their connectivity with this framework. So they really managed to have a huge cost reduction and a huge reduction in terms of errors thanks to the use of decentralized ledger technologies.
Okay, interesting. And maybe the last question for this part of presentation. Tokenization is beginning to democratize access to traditionally illiquid assets, such as private equity or real estate. So my question is, how is this trend reshaping wealth management business models, and what new value propositions are emerging as a result?
Definitely, that's a very good point, because especially for liquid assets, for instance, for real estate or private equity, those assets have been usually on the hands of a small amount of people because they have very high barriers of entry. But thanks to this technology, we can tokenize pretty much anything. An example is this platform is called Realty. Realty is an American platform where they're offering the people the opportunity to invest in real estate starting from $50, as low as $50. So you can see actually the properties in their website. You can see how much they're valuing the properties, how much is the rent, and then people can buy tokens that represent a fraction of those properties, starting from as low as just $50, which is nothing. And then via a set of smart contracts, because those tokens give you the right to vote, obviously, on the decisions about that specific building. They are usually leasing the buildings, leasing the properties. So if they have to vote whether they want to install solar panels or not, just because you hold $50 US of that property, you can still vote. Obviously, same as with shareholders meetings, that if you're a shareholder, you can obviously vote. It's the same setup. Another example is with Hamilton Lane, so probably a bit more well known for the participants in the call. They had a very, very liquid fund that they decided to tokenize. So usually for that type of fund, they have an entry ticket of 1 million. And because of the use of blockchain, they managed to create, to save around 40% of the cost to create, those type of efficiencies. So they lowered the barrier of entry to 100,000, still high, but much lower than obviously 1 million. And they believe that because of this technology, because of the possibilities that tokenization brings to the market, they are going to be able to capture a 50% higher share in terms of clients, because they are going to lower the barriers compared to the clients that they were getting before. So we are really going to witness kind of a true democratization of investments of many of these liquid assets in the coming years.
Okay, thank you again, Veronica. And now I suggest to move to the second part of our presentation. So we'll have a look on regulatory landscape. So Luxembourg has taken a leading role in Europe with its series of blockchain laws. And my question here is, why are these laws so important for the development of a robust digital asset ecosystem in Luxembourg? And is there any practical impact that we are seeing on the ground?
Thank you, Katya. I'll take this one. It's a very good question. And we here in Luxembourg, we cannot really talk about the development of the ecosystem, the blockchain ecosystem, without mentioning the blockchain laws. They were passed in Luxembourg between March 2019 and December 2024. And the interesting thing is, instead of approaching DLT, distributed ledger technology, as a parallel, separate system, the blockchain laws actually integrated this new technology in the country's existing financial laws. So instead of creating sort of a standalone separate regime, the Luxembourg lawmakers embedded this new technology into the existing legal framework. So we could say that before the blockchain laws, all the DLT-based ecosystem, tokenized assets, they operated in a sort of a gray legal zone. And as we know well, investors and issuers, they require legal clarity before adopting new technologies. So all the uncertainty and ambiguity that existed before those laws were passed, they were slowing, if not really hampering, the development of this new digital ecosystem. But thankfully came the blockchain laws, which provided a framework for using DLT into, let's call it the regulated finance. So as a result of this, Luxembourg started attracting not only banks, asset managers, and big custodians, which became more willing to adopt DLT confidently, but also a growing number of fintech startups, tokenization platforms, and others that were looking for an European hub for their digital activities. So in summary, I would say that those clear rules really reinforced Luxembourg credentials as a digital financial center and innovation hub, which obviously quite nicely complements Luxembourg's traditional strengths in fund administration and private banking.
Yeah, okay. Thank you for your answer. And MiCA has been fully implemented as of December 2024. So what should board expect in terms of new compliance obligations? And where do you see the main business opportunities emerging under this regulatory framework?
Yeah, maybe we jump one or two slides forward. Yeah, we stopped there. Yeah, okay. Thank you for that. So yeah, let's talk a little bit about MiCA, because this is quite relevant for us, Luxembourg and Europe, right? So since MiCA fully kicked in, the boards have been operating in a different world where authorization, conduct, disclosure, and market abuse rules are real obligations. And we should try to break this down a little bit. So what MiCA did was, or does, is to establish a single EU-wide framework for crypto assets that were not covered by other existing rules, such as MiFID II. In other words, MiCA has brought crypto assets into the EU regulatory perimeter, which effectively ended the gray zone in which crypto was operating without supervision. So what is really the core, or what is at the core of MiCA? have to bear in mind that the focus really is governance, consumer protection, and prudential standards. The regulation was drafted based on two main guiding principles. The first is same activities, same risk, same rules. This works as follows. If a specific crypto asset already meets the definition of a security under existing rules, like, as we said, MiFID II, that rule book takes precedence. So to be clear, crypto assets that are securities in the digital form are excluded from the scope of MiCA.
Mhm.
The second principle is of technology neutrality. Here, the focus of the regulation is what the asset function is instead of on the technology that is behind it, which is very important, leads us to the core piece of MiCA, which is the classification of crypto assets, which Veronica mentioned before. So the regulation divides them in three main types, categories 1, 2, and 3. So category 1 are asset reference tokens, or ARTs. So those tokens are referenced to one or several official currencies or a basket of assets. So if a stablecoin is backed by a mix of euro, dollars, government bonds, that would make it an ART or ART. The category 2 are electronic money tokens or EMTs. So those EMTs, they are referenced to one single official or fiat currency, say the euro. And there are very specific rules for protection of holders. So the holder must always have a direct claim against the issuer. The holders must have a contractual right to redeem that token at any time for the underlying currency of the token and, very important, at par value. And the issuer must be an authorized credit institution or a licensed e-money institution. So as you can see, very robust framework, particularly for the first two categories. The third category includes all other crypto assets like Bitcoin, Ethereum, and the utility tokens that Veronica mentioned at the beginning. So in terms of authorization, if you're based here in Luxembourg and want to provide MiCA crypto asset services, then now you need a crypto asset service provider or a CASP license from the CSSF. All the issuers of ARTs, the ARTs, and the EMTs, they face very strict asset reserve, redemption, and transparency obligations. And the main reason for that is to prevent runs and protect the consumers. Those asset reserves are meant to ensure that the tokens have a stable value and can be redeemed at face value. Those reserves, they consist of cash and highly liquid, low-risk financial instruments. Another important thing is that the issuers of the ARTs and the EMTs, they are prohibited from paying interest to holders or to give them any other form of compensation that effectively act like interest, such as a discount or something like that. That effectively stops stable coins to look like savings accounts or money market funds. The core idea is to make tokens function primarily as means of payment or means of exchange and not as investments that generate yields from the reserve assets, which not here, but particularly in the US, which has similar restrictions, we hear more and more calls to reverse or to revert this type of prohibition. But staying here, paying interest in the vision of the regulators, the European regulators, paying interest could create the sort of incentives which might conflict with the idea of keeping a safe reserve to meet redemptions. That's why this is so tightly regulated and the payment of this interest is precluded. Now, for most public offerings of crypto assets, you need to write a white paper. And this white paper has to cover essential information on the issuer, on the project itself, the rights and obligations of the crypto assets, the underlying technology, and the risks involved. So it's a quite complex document, which may inhibit even some people from coming to the market to issue these crypto assets. Now, in terms of governance and organization, which is a key aspect for the boards, boards can expect fit and proper tests for management, requirements, strict requirements on segregation and safeguarding of client assets, conflict of interest, complaint handling, outsourcing governance arrangements, plus DORA alignment for ICT, plus prudential and own funds requirements. So it's not a walk in the park by any means. Yeah? Now, there is a flip side to it, which is there are genuine cross-EU opportunities to go after. So the combination of the MiCA regulation with the EU passporting system allows a company with a license in one country to operate in all other member states without seeking a separate approval that enable cross-border custody, brokerage, or advisory of crypto under one regulatory playbook. So clear rules obviously allow companies to innovate with greater confidence. It comes at a cost. MiCA has not really created a stablecoin boom in Europe. But in a way, it has nudged the market towards a new generation of bank and EMI issued fully reserved stablecoins. So there is an expectation that with time, European stablecoins can sort of underpin merchant payments, business-to-business settlements, and other use cases. But this is probably a topic for another occasion.
For sure. Listen, in the meantime, I see that we have one question in the chat, so I suggest to take this one. So, Spunta project would be an option for Luxembourg, or do we have other options? Guys, what do you think?
Very good question. I'm happy that somebody asked this question. Definitely it would be an option for Luxembourg. Rather than trying to establish our own blockchain, our own pipelines, I think it would make sense to connect to some existing pipelines. So the pipelines that have been set up by the banks in Italy that now are also starting to connect with banks in France and Germany to benefit from that systemic approach at the end of the day, rather than to do something on our own. So definitely I think it would be a good idea. If they want to establish something for Luxembourgish banks, that's completely fine. But as we are market players working within the European Union, I believe we will benefit way more if we connect with the system that has been already set up and that is working for the Italian banks. So definitely ABBL, I hope. I don't know if there is someone from the ABBL Association in the call, but they should definitely put this option on the table and bring some interesting value for Luxembourg here.
Very well. So listen, I suggest to move to the last part of our presentation, focus on risk and governance. And here,
Katia, if I may just just to add to the Joao's part, that was super interesting. So thanks, Joao. I think you really covered the most important points for Mika, which is very extensive. So it's very hard to talk about it in such a short period of time. Just to highlight that obviously Luxembourg is really trying to position itself as a blockchain hub. However, there are other countries in Europe that are speeding up on this race. One of them, for instance, is Malta. So looking at the number of licenses, MiCA licenses, CASP licenses, so crypto asset provider licenses that Malta has delivered, I have some data from September. So they deliver 47 licenses versus 15 in Luxembourg. And what I'm hearing from other colleagues who are also applying for this type of licenses is kind of a bit difficult in Luxembourg. It's taking up to 1 year at least, and obviously having to establish a structure in Luxembourg also has a higher cost versus other locations within Europe, because labor cost and real estate costs, etc., they're much higher in Luxembourg. So it's quite interesting to see how, even though we are talking about a European regulation, within the different countries, because there are these passporting rules, so once you have a license given by one European Union country, then you can leverage that license in the rest of Europe, as mentioned by Joao as well. So it's quite interesting what is happening. We see Lithuania as well being a front runner. And ESMA started to show some concerns regarding some of these countries who are providing crypto licenses relatively quickly, and they have praised so far Luxembourg for having quite of a robust process, even though it's slower. So it's always a bit between leveraging regulation versus what is good for the business and what is good to bring business within the country.
someone also in the chat mentioned the Netherlands.
And the Netherlands as well, definitely. The Netherlands, they're also on the top together with Lithuania and Malta. I think Netherlands is kind of the third or fourth country that has provided most crypto provided CASP licenses in Europe.
And Wanda also asked, has the oversight of stablecoin issuers in the US been solved? And she also saying in the past there were some doubts about the assets they really detained.
Yeah, this is a very good question. Thank you for asking it. So indeed, the US government passed last July the Genius Act, which, similar to MiCA, establishes a framework for payment stablecoins in particular. And there are very strict, specific regulations also for reserves, for redemption, for licensing. So if you want to operate in the US as an issuer of a stablecoin, you need to have to be licensed under the Genius Act. So the main provisions are you need to be, or the stablecoins need to be backed one-to-one, high quality liquid assets, cash, short-term treasuries, that sort of things. You need to do monthly disclosures of reserves. You have to provide clear redemption rights. In this way, it's similar to MiCA. And so it is not perfect, no regulation is, but it provided a clear framework for stablecoins in the US, which, the market is already enormous, it's hugely concentrated. The market for stablecoins is hugely concentrated in the US. And what market commentators think is that the Genius Act will even accelerate the growth of the market in the US.
Okay, listen, as the time is running out, we're still fine. I suggest just to cover the last part of presentation, and in the end, we'll, if time allows, we'll take the question that are new questions that are still in the chat. So when it comes to risk and governance aspects, how should board members face the governance challenges of blockchain technology? What do you think?
Well, to a director, governance of DLT, the distributed ledger technology, can be really a fascinating topic. I speak for experience, but it can quickly become a nightmare too. So you have to bear in mind that DLT completely redefines governance. It introduces a whole set of new questions. The governance challenge starts with the architecture of the DLT because actually the risk changes completely depending on how you build the platform. So the fundamental strategic choice is about two sets of rights, access rights and validation rights. So in terms of access rights, the choice is between a public DLT, public network, open to anyone, or a private network where access is restricted. In terms of validation rights, the question is about who can confirm the validity of transactions. Is what we call a permissionless DOT, where anyone can be a validator, or permissioned, where the validators are known, authorized, and trust each other. Those strategic or governance choices have a profound impact on the legal risks you have to mitigate and manage. That's why it's so important. Now, it's not the only critical point. Another one is accountability, because in a decentralized system like the DLT, the accountability lines become blurred. This confusion introduces one of the biggest nightmares or governance nightmares, especially in public DLTs, the liability gap. So in public DLTs, there is often no formal contractual relationship between the stakeholders, be it the users, the node operators, the original developer who wrote the code. So if something goes wrong, so say there is an outage, it is unclear who is liable for the financial loss. Trying to define liability or setting up a dispute resolution process is almost impossible when you don't have a contract binding the parties. So, and that's what is really, concerning with those public DLTs. So just to conclude why governance matters so much in the context of DLT is because it determines who controls the rules of the platform, how any changes are made to the platform being an upgrade, how disputes are resolved, and how the risks ultimately are managed in a system that is supposed to be totally decentralized.
Okay, very well. Listen, Morgan, digital asset activities come with risks and they are quite different from those in traditional financial systems. So could you please explain us what are the key new risks that blockchain technology introduces for financial institutions? And how should boards ensure that these are properly identified, monitored, and or mitigated?
Absolutely. We should start by understanding what are the two core things that make DLT so special, so different from the old centralized databases. the consensus mechanism as the use of cryptography. So as Veronica mentioned, the consensus mechanism dictates how all the different computers in the network, the nodes, have to collectively agree on any new data before it is added to the chain. All the nodes on the network have to follow a set of predefined rules to validate any new date. So only once the consensus is reached, the information is added to the blockchain. The second crucial component is the cryptography layer. So this is key to guarantee three critical properties of any DLT. First is the immutability, meaning that data cannot be changed, cannot be retroactively altered or deleted. This is very different from a normal database where an administrator can go in and modify any records. With a validated DLT record, that is simply not possible. Records are permanently secured and permanently auditable, for good or bad. The second property is non-repudiation. That means that participants cannot later deny that a transaction that they were part of it. The system verifies the authorship. And finally, the third property is authorization, excuse me, which uses pairs of public and private keys to prove that a transaction was initiated by an authorized user. So let's have now a look at the technical risks which are unique to DLT, starting with smart contracts. So the code written in a smart contract is self-executing and final. A single bug can result in the irrevocable loss of all the assets deployed to that smart contract. And in a public DLT, everyone can see that code, including hackers, which may be willing to explore any vulnerability of that smart contract. So it's absolutely mandatory, really, to get multiple independent security audits to prove that the code is sound before you deploy it. Smart contracts are also dependent on something called oracles. An oracle is basically a node that certifies real-world events and feeds the data into the DLT. It could be stock prices, trading volumes, reference data, anything that is external that you need to feed into the blockchain. The problem is if the oracle feeds bad data into the chain, the smart contract execution will be compromised. So you really have to define upfront what happens if the data is wrong or unavailable. As we said, taking into account the immutability of the DLT, that is a problem that you have to be prepared to discuss how you're going to react if happens. Another very unique challenge is key management. And this is critical because it represents really sort of a paradigm shift when you're thinking of managing databases. In both the public and private DLTs, an account or a wallet, as Veronica mentioned, is defined by a pair of cryptographic keys, the public and the private key. Those key pairs are essential for identification, signing transactions, and ultimately proving ownership of the assets that are recorded in the DLT. So if the user loses the private key, the assets are still in the blockchain, but they are unreachable, they are unrecoverable forever. So the good news is that there are ways of mitigating the risk. So there are procedures for key generation, delivery, multi-signature wallets. There are a bunch of new things that can be done in order to manage this risk. So I think that, or I hope that one of the key takeaways of this discussion is that DLT offers very powerful, truly transformative technology with advantage that are really cost-effective, transparent, but the choice of architecture has a very big impact on the governance and could radically change the risk profile of the institution.
That's very well. Listen, we have 3 minutes left. So if you could explain us in 1 minute, last question, what is the difference between ARTs and stablecoins?
Actually, the RRTs are stable coins. So the stable coin is the more generic name. The ARTs and EMTs are, let's say, the regulatory names or the taxonomy given by the regulator to the stable coins. So two different types of stable coins, the ARTs and the EMTs. One is much more focused on a single specific currency, the EMT. The ARTs, you can have a basket of assets, a basket of currencies, but in essence, they're both stable coins.
Okay, very well. Listen, it was very interesting talking with both of you today, and thank you to all participants. We had some questions, which is always nice. We had almost 60 people today, which is also a nice number for today. As we are seeing a lot of interest from the ILA members, we'll surely get back to you. We'll organize additional sessions on digital assets. So yes, please have a look on ILA website. You'll surely see updates in the future. So thank you again. Have a nice day. Have a nice weekend. And we'll see each other hopefully soon.
Thank you, everyone. Thanks also for the